Hey everyone, this is Brent from Wolf on Wall Street Trade with the market update for the week ending September 4th, 2020. So, quite a week. We're looking at the S&P 500, a daily chart. So it made a couple new record highs this week, and the NASDAQ 100 did as well. And then we got some really ugly price action on Thursday and Friday. So let me do a quick overview. This is the S&P 500 daily chart. Since we had this rotation over here to value cyclicals, which would have been positive development if it had stuck, it didn't stick, it came down, then we had earnings season, kind of went sideways for a while. So in early August, that kind of rotation to value and cyclicals started again, but it only lasted about a week and then it failed. So then we got basically all through August, just the mega cap tech stocks were just running the entire market. This is a 15-minute chart of the NASDAQ 100 in the candlesticks here, and this is IWM or small caps in the white line. Here's that early August rotation to basically value and cyclicals, but it benefited small caps and money was coming out of NASDAQ. This is really highly unusual to see this inverse kind of trade between two market averages. Usually they move together and one will outperform the other, but this looks almost like what you would see the S&P versus the VIX, almost inverse. So this is about when that rotation failed, and then you just saw everybody pile back into the mega caps right around here and just blast off through the rest of the month of August. You can see small caps really didn't do anything at all. So if we're looking at NASDAQ's daily chart, here's a key reversal day. It was really struggling right around this 11,000 level. This is where that rotation started to small caps. You can see money was coming out of NASDAQ and large caps. It failed, and then everything just went into mega caps. Now, it appears the reason we're finding this out through some reporting on Friday is that SoftBank, who brought you such wonderful unicorns as WeWork, was aggressively buying calls on stocks that they had already purchased in the second quarter, basically the mega caps, Facebook, Apple, Amazon, Netflix, Google, all those. And it appeared to be an attempt to kind of corner Gamma and reprice their portfolio higher. So what was going on was the upside calls for these kind of stocks, premiums were insane. So the dealers saw all these high premiums to write calls, so they were writing calls. But then when the price would go up, they would have to buy the stock to basically hedge their underlying position of those calls they sold. And it caused like this vicious loop. The more the stock went up, the more they had to buy, and you got this kind of parabolic activity, real speculative kind of activity. So Amazon added more to its market value in a month than it did all of last year. Okay, so Tesla's founder, Elon Musk, he became richer than Warren Buffett. And here's Apple. It was like the poster child for this August advance. In 2019, Apple made it to a market cap of $1 trillion. After 35 years, they made it to $1 trillion. Since then, that was just 2019, Apple's market cap went up to $2.3 trillion, more than the entire Russell 2000 together. Apple's calls were selling 3 to 4 times more in premium than the puts. And because of their weight and their influence in the other averages, like the S&P 500 or the Dow, the NASDAQ 100, it pushed multiples up to record highs. This is the dot-com bubble where, these were the most extreme multiples in history. We passed those. And just look how frothy and euphoric this is. We're looking at 30 years. You don't see anything like that until after the crash over here the last few months. Warren Buffett, this is his favorite indicator. It's the Wilshire 5000 versus US GDP. This is the most extreme valuations at the dot-com bubble, 1999, 2000, blown right past those. So that may explain Warren Buffett selling a lot of US stocks. And if we come back to our S&P 500 chart, what we have seen is like since June, especially July, market breadth getting really bad, and especially August, like almost every day getting worse and worse and worse. And that's because there was only 3, 4, 5 mega cap stocks that were driving the entire market higher. Actually, I think it was Monday, the NASDAQ was up, and Apple and Tesla alone were responsible for more than 100% of its gains. Here's the S&P 500. It made a new record high above this February high. Of course, NASDAQ had already done that. If we look at the equal weight index, check it out. It's nowhere near the February high. The value line geometric index, which is what the median stock is doing, it's like over 13% off of its 2020, early 2020 high. And the same deal for NYSE, which is the broadest index in the US. Small caps, all the same. They hadn't made these new highs. In fact, not even the Dow had. This again is a daily chart of the S&P 500, and in yellow down here is the count of NYSE stocks that are making new 52-week highs. So here is the February high, and here is the recent new record high for the S&P 500. When we had a rally here making higher highs, you see NYSE stocks making new 52-week highs, that it's trending up. Now, if you compare to over here where price is higher recently, what do we have? Far fewer NYSE stocks making new 52-week highs as the averages like the S&P and the NASDAQ were. So what we're going to look at is this area right over here. And this is that area I zoomed in on for the S&P 500. So this time we're looking at NYSE stocks that are making new 52-week lows. When a market is pulling back, it's normal to see this rise. But when a market is rallying like this, you should never see more and more stocks making new 52-week lows into this rally. And this wasn't just like a couple of days or maybe one bad week. This is a trend of months, and it just got worse and worse and worse. Even within the NASDAQ itself. This is the NASDAQ 100 in candlesticks, daily chart again. And this white line is the NASDAQ Composite Advanced Decline line, right? So over here into 2019's rally, you can see that it is moving up with prices, except when we get into February. Negative divergence there, right? That's right before the crash. Look at it now, where the NASDAQ is well above this February level. The advanced decline line is way down here. Even worse, we're looking at it on a 30-minute chart. Same thing, NASDAQ and the composite advanced decline line. You can see when we get into June, it kind of flatlines, right? And so does the NASDAQ pretty much right in here. It's kind of having problems right around 11K, right? When we get into August, here's August 3rd. Look at the NASDAQ stocks, the NASDAQ advanced decline line, what they are doing throughout all of August. So it doesn't matter if you look at the NYSE stocks, if you look at the S&P 500 stocks, or if you look at the NASDAQ stocks, same thing. You're seeing fewer and fewer stocks participating, more stocks making new lows, when only 3, 4, or maybe 5 stocks are driving the entire market higher. As you'll see the rest of this video, there are more parallels with 2000, which is really odd, being that we have a pandemic, a recession, and tens of millions of people unemployed. What this shows is the S&P 500 in the top, and in the bottom is the percent of S&P 500 stocks, the actual component stocks, that are above their 200-day moving average. So if you look at it compared to February, the number of stocks above their simple 200-day moving average is far lower. And as a matter of fact, I wrote a little condition here so I could look back historically. If you can see this yellow arrow, that tells me that we are seeing fewer than 60% of S&P 500 stocks above their simple 200-day moving average. Here's the S&P, here's its 200-day in blue. So you would think a lot of stocks in the S&P 500 would be doing the same thing since the index is way up here. So what we're going to do is look for these little yellow arrows. So we go all the way back. Here is the financial crisis, 07-08. No yellow arrows anywhere here, just right there. The only time that we see them is if we go back a few more years. Right there at 1999, 2000, the tech bubble or the dot-com bubble top right there. That's the only time this particular metric of market breadth was as bad as it has just recently been. So when they say party like 1999, yeah, in a lot of ways. One other thing that has been popping up recently is relative strength in volatility. As a matter of fact, VIX was up almost 34% this week. So here you can see VIX, but relative strength isn't necessarily this, what you see standing out. It's relative against the S&P. So we look for subtle changes in character because subtle changes in character lead to changes in trend almost always. In August, while the S&P and NASDAQ are making new highs, we start to see VIX not really going down much, and then it starts showing relative strength, even though the S&P 500 is still going up. This is just this week, where we got this big burst. Look what VIX has been doing as the S&P and NASDAQ have been making all-time new highs. It's been trending higher. People will give you all kinds of explanations as to why, but I can tell you historically, it is a warning sign. If you remember, you're probably sick of this. You've probably seen this every single day for the last 10 days or so, but for everybody else, let me show you real quick. We're looking at a daily chart of the S&P 500 in green and VIX in white. You can see they kind of have like this inverse relationship, like a Rorschach picture or whatever, but we're going to take a closer look right over here. So this is a 15-minute chart. You can see over here S&P is going up, VIX is going down, and then in August we start to see a change. S&P is going up, but VIX isn't going down anymore. And then VIX is starting to go up, even though the S&P 500 is going up. That is positive correlation, and historically, when that happens long enough, it is a big warning sign. So I am going to show you with a different perspective. So we're back at the daily chart, and this graph in the bottom is the correlation between the S&P 500 and VIX. It's a 15-bar correlation. So when it's down here, this is kind of normal. They kind of move opposite each other. But when it's trending up like this, it's turning more and more positive. And when it moves up like this, you're seeing a really strong spike in positive correlation like we just saw. That's this spike here. Now let me change these over to red. And we see over here the sell-off in January of 2018, which started this whole broadening top. We see it again over here just a little bit before this big sell-off, which was almost 20%. We see it over here right before the trade war heated up and negotiations just collapsed. And we see it again before this huge crash that we just saw this year. And when did we see it? Most recently, the last couple of weeks, increasingly so. This has been a big red flag for me, and I've been talking to my members about it just about every night and saying, look, it keeps getting stronger and stronger. The stronger it gets, the bigger of a problem it is, historically speaking. I just rolled this chart back. This is the NASDAQ. You can see the date down here, 1999, 2000. That is the tech bubble top, and we saw the exact same thing there. Really high correlation between the NASDAQ and its own volatility index. Same thing with S&P. Matter of fact, this happened right before 1987 crash. It just historically, the longer it goes on, the stronger it is. Historically, it has not been a good sign for markets. Here is QQQ on a 60-minute chart, and I've only shorted QQQ or NASDAQ a handful of times this whole year. Usually, if I'm going to short something, if I think the market's going to turn, I usually start with small caps because they're more sensitive and they usually turn first and they usually act worse. NASDAQ usually acts much better. It doesn't sell off as much. But this was one of the first times, I think, this year, maybe the last couple of years, that I went into NASDAQ short first. Actually, I shorted it over here. So originally got into it on Friday, August 28th. So that was right here. The reason for this trade, because we saw all these other things going on with the market breadth and with volatility. But the reason I got into this was because this channel, NASDAQ channel, has been really strong. And prices moved to the top of this channel. So I was looking for a move down to the bottom of the channel. So I started a short position in NASDAQ on Friday, August 28th, right in this area. So the last time I shorted NASDAQ was right here. Actually, that was the last time I shorted it, and I covered it right in here. A little bit early. I didn't get the full move down to the bottom of the channel, but that was the last time I shorted it. So it hit this channel again, and I started a short in NASDAQ. And I also got another good reason to go with NASDAQ instead of small caps or S&P. So this is Tuesday over here. 3C started to negatively diverge away from price. And then we got into the next day, Wednesday over here, still negatively diverging. That's when I added to my short. And it kept on negatively diverging. And even as prices fell, 3C kept leading prices lower. And also got the same signal in NQ. Here you can see NASDAQ 100 futures. And this is 3C over here in blue. Negatively diverging. There's Monday, here's Tuesday over here, getting worse and worse. So into this rally over here on Wednesday, it's negatively diverging and leading prices lower, and then finally prices crack and catch down to what 3C is saying. Back to that QQQ chart, and this is 15-minute. Here's where we got short above this upper trend line, and not only did it hit the bottom of it, but I told members, I said, this is a channel buster on the upside. Sometimes when you get these, they're kind of like a bull trap or a head fake, and you get a lot of momentum up, and then you get so much momentum on the way down. It doesn't just hit the channel, it busts through it. That's why I call it a channel buster. By Friday morning, prices retraced almost 3 weeks of gains in less than a day and a half. 13 days worth of gains, grinding higher every single day, every single night. Retrace that in less than a day and a half. Stocks fall a lot faster than they rise. Risk builds up slowly, and then it happens all at once. 3 weeks of gains wiped out in about 8 hours. What's interesting is where this actually happened. For the Dow, it was filling in this February crash gap. And keep in mind that the Dow did not make a new high like the S&P and like the NASDAQ. NYSE didn't make a new high. Small caps didn't make a new high. Here's the S&P 500 on a weekly chart, and I've been pointing out this broadening top. I mean, look how big it is compared to the dot-com top over here or the financial crisis top over here. Look how big this broadening formation is. I've never seen one this big in any asset, and certainly never in a major index. So if we take a closer look, where did this turnaround happen? This is a daily chart. One day after the S&P tagged this upper trend line of this huge broadening formation. The very next day, you're getting one of the worst sell-offs we've seen in a long time. Now, this is just a point of interest, but for the Dow, very similar to the Dow's counter-trend rally, the crash in 1929 and its counter-trend rally. So I'm going to take you back and show you that real quick. So this is the Dow's initial crash in 1929. This is a counter-trend rally. It was probably the most spectacular counter-trend rally until 2020. And after that, it rolled over and it turned into this huge bear market. And I'll just give you some idea of what it looked like here. Horrible bear market. Lost about, I think, 88% of its value. So that counter-trend rally is very similar to the Dow now. And I have a horrible graphic, but maybe it will help put things in perspective a little. I told you it was horrible. What you're looking at is the Dow 1929 in this black line, and this is the Dow in 2020 in the candlesticks. So let me just rattle off some of the parallels. The Dow's 1929 crash, again, this black line, was about 48%. So from here to there, this is the counter trend rally. The Dow in 2020, its crash was about 37%. That is the red and green candlesticks. Okay, so I started this chart exactly where the counter trend rally started. What started both counter trend rallies? The Federal Reserve taking action. In 1929, it was the Fed cutting rates to the day. The very next day, the rally started. Here we have just an alphabet soup of Fed programs that they started, I don't know how many, 10, 12, 100. In 1929, the Dow's counter-trend rally went up 49%, and it did that over a period of 20 weeks. You can see I have these overlaid both in weeks, so it's the same scale as far as time goes. 20 weeks, 49%. The Dow in 2020 over here in the candlesticks, 56% in 22, if you want to count last week, 23 weeks. So there's about 3 weeks difference, a little difference in how much it crashed over here and a little bit of difference in how much it rallied over here. But you can see very similar. Is it a counter trend rally? Is it a bear market rally? I think the probabilities are higher than not, but that's not why I'm showing this to you. I'm showing it to you to say there is precedence. It's not beyond the realms of reason. Couple other parallels. Like I said, Fed cut interest rates both times. But what a lot of people don't know is back in 1929 and 1930 over here at the black line, the Fed bought assets. They had a QE program. And in today's dollar terms, it was about $2 trillion worth of asset purchases. A lot of parallels. So I told my members at the end of the week, because I do have that short on, expect that the invisible hand that moves markets is going to do everything it can to have a strong close over a 3-day holiday weekend. The powers that be don't want people at home on a 3-day weekend thinking about this crash that just happened and the media going on and on about it all weekend. So generally, that's what you'll see on any weekend, and especially a holiday weekend. Here's a little closer look at the NASDAQ 100. This is what I shorted. Notice this sort of hanging man candle over here on Wednesday, and we got something like a hammer. So it did not touch its 50-day moving average. But if you look at the NASDAQ composite, it pretty much tagged that 50-day moving average, and also small caps did the same. So you can see there was some technical support. So the question is this horrendous 2-day sell-off that retraced almost 3 weeks of gains, and this is why I'll be patient with shorts, because I know I could sit in this market for 3 weeks knowing how overvalued it is and how bad the breadth is, or I can get in hopefully at the right time, make basically 3 weeks worth of gains in 1 or 2 days. So that's what I try to do. I don't mind going long the market, but when I see as many red flags as have been building up, no. So is this the start of something nasty, or as they say on CNBC, is this just the pause that refreshes? Nobody can answer that question, but we have price rejecting off of this broadening top trend line, rejected to the day. We've got this ultra high degree of correlation between the S&P and between VIX. So this is the broadening top, by the way. You have higher highs and you have lower lows. So at almost every one of these tops, what do we see? We see this massive spike in correlation and prices drop. From this shorter term perspective, this is 30-minute chart of QQQ. I think there is a good chance that this is a channel buster. We almost had one back here, the last trade we did finally find support at that channel. Kind of got nasty though. So we may have a channel buster here where it just breaks down this channel, kind of comes down and back tests here. Or we may see, like I've talked to members about different scenarios, maybe it bouncing up and back testing this channel just like it did last time, which was over here, initial break, and then kind of bounced up, and that's where I shorted it last time. So if it does something like that, I will increase my exposure more because I didn't get the size I wanted, full size on the trade. I usually leg into trades like this. And one other thing that is worth considering is how bad this break was, how bad this sell-off was. And what I did was put together a formula and said, is this true or false? Has this happened before where we get a new high in the S&P 500 and then we get a really nasty bad sell-off? This was the worst sell-off off this high, not only in the last couple years, taking it all the way back. Look for those red candles. Here is the financial crisis to the far left. Let's keep on going. And now we're pretty much all the way back to 2002, 2003, 2001. There's the 2000 top. I don't see another red candle here. So as far as I can tell, is the worst sell-off from an all-time new high. Worse than it was right over here. And now we'll look for the NASDAQ 100. So we did have one as bad over here. This was an all-time new high at the time and a really bad sell-off. That was June, so early June. That's after that initial rotation to value failed. So let's look back and see how often this has happened. So all-time new record high and a big nasty sell-off over a certain percentage. Again, we're going all the way back. There's the financial crisis. None. We have to go all the way back, and in this case, to 2000. And this is the .com top, March of 2000. Let me zoom in a little bit. Thought this was really interesting. We had one really nasty sell-off. That was an all-time new high at the time, or a 52-week high, and a nasty sell-off. And then right here at the top, these are about 2.5 months apart. So a really nasty one here, about 2.5 months later, another one here. Guess what? It's the exact same thing that we have right here, about 2.5 months between them. So that looks, at least from this perspective, this scan that I'm doing, looks exactly like the .com bubble, the tech market bubble high. Make of that what you will. We'll manage this trade. I'm still in it. I'm still short this, but I would like to add to it. I wish I had added, full size over here, but hindsight's 2020. I know some of you went long VIX instead of shorting NASDAQ, which I think was brilliant because that's been a fantastic trade. So that was something like 34% up to here and almost 14% to there. That was a good trade. And that's what I encourage everybody to do, is make the trade their own. Okay, so that will do it for this video. I hope you enjoyed it. If you did, please give it a thumbs up. You can follow me on Twitter. I've been calling out this volatility strength, put up a couple charts. Check out the website at Wolf on Wall Street Trade. I have a link for it in the video description. And you can sign up to get free posts. I had a free post out this week, one of the daily wraps, one of the extensive ones. Or you can check out becoming a member. So don't forget to subscribe to the videos and don't forget to turn on the alarm so you know when a new video is out. Thanks, everybody.